So in the books of Zuri Hotels, in the books of Zuri Hotels, this is the profit and loss account. Profit and loss account for the year ended 30th June 2002. Similarly, we have the profit and loss appropriation account. Profit and loss appropriation account. Then we have the partners current account here. Partners current account. Instead of putting amounts, I'll write their names. We have Mahesh and Rajesh. Mahesh and Rajesh. And balance sheet as on 30th June 2002. We'll start with the items. We have capitals first. Now, since there are current accounts, the capitals are going to remain fixed. So, directly to the balance sheet 70 and 60. I'll just change this since it's given this way. Rajesh is given first. So we have capitals directly in the balance sheet. Rajesh and Mahesh 70 and 60. $70,000, $60,000. Then there is drawings 4,000, 8,000. I told you before you before you enter the drawings, always try to put the other items first. Okay, so to start with the current accounts because we know drawings go into the current accounts. So I'll start with this. One has a debit balance, one has a credit balance. So Rajesh has a debit balance of 500. So on the debit side, two balance brought down 500, whereas Mahesh has a credit balance by balance brought down 200. Then we have gross profit 121,580. The trading account has already been compiled 121,580. Then there is salaries 45,520. Salaries, two salaries in the inner column because there's a outstanding salaries 45,520. Deposits for advance booking 1,500. I'll leave space for current accounts. Then we have creditors 8660. To this we have an adjustment, so I will write it in the inner column. There's those unrecorded provisions, 8660. Then there is fuel 9680. I'll leave a line for that adjustment on salaries, 9680. Premises 1 lakh. There's depreciation on this, so in the column. Premises 1 lakh. Then there is bank balance 49,860. I will just leave some lines for the other assets. Bank balance 49,860. Similarly, we have the cash balance 660. Then we have repairs 3740. Two repairs 3740. 3740. China cutlery and linen 9,000. China cutlery and linen 9,000. Discount received 1560. Visitors ledger 4540. That's our debtors. Four five four zero. Restaurant furniture 13,600. Furniture 13,600. Advertising 5020. Bad debt 780. Then there's an adjustment to this. Loan account 10,000 in the balance sheet. Leave a line for the adjustment. It's a loan taken. It's a liability because it's showing a credit balance. It can be a low asset as well if it was a debit balance, right? It's a loan given. Rate 6,700. Two rates 6,700. Then there's laundry 3680. Two laundry 3680. And then we have the last one that comes here is 1220 insurance. To insurance 1220. So we have posted everything from here. Just remove these additional rows. Okay. Now we move on to, okay, I think I missed out one. I missed out drawings. I forgot to put drawings. Rajesh and Mahesh, 4,000 and 8,000. That goes in the partner's current account to drawings. Since it's a debit balance, drawings are always debit balance. two drawings, 4,000 and 8,000. Yeah, I think that's it. We have posted everything. Now we come to the adjustments. Our stock of provisions also is left here, 7,000. This is the closing stock which will go in the balance sheet. Stock of provisions, 7,000. So we start with the adjustments. Provide for outstanding salaries, 500. So add outstanding salary, 500. So that comes to 46,020. This comes to 46,000. Then this also goes in the balance sheet as outstanding salary, 500. Then we have of the debtors, rupees 400 are bad and hence should be written off. So that's new bad debts. And besides the bad debts that we already incurred, we have further bad debts, new bad debts, 400. So that comes to 1,180. And same way we need to minus those bad debts from the debtors because of these debtors or visitors ledger, 400 are bad. So less new bad debts. I wrote this outside by mistake. New bad debts are 400. So that comes to 4140. 4140. Then there is China cutlery and linen were revalued at 8,000. So that becomes the new value. So the new value is 8,000. Hence, the depreciation becomes 1,000. Less depreciation, that is 1,000. Okay, we'll transfer all the depreciation together. I'll write off furniture and premises as well. Furniture is 10%, premises is 16,000. This is 16,000. So outside we have 84,000 and this is 10%. So that will be 1360. 1360. So that comes to 12,600, 12,240. Okay, the same thing we need to transfer to the profit and loss account to depreciation. To depreciation, premises, it is 16,000. Furniture, it is 1360 and China, it is 1,000. I think so. 1360 and 1,000. So this is furniture and this is China. China and cutlery. Then we have Provisions worth rupees 5,000 were purchased but not recorded in the book. So these go as unrecorded purchases. Okay, so I can just show it as two provisions, like an expense. Two provisions. Provisions worth provisions worth 5,000. Provisions worth 5,000. And the second effect will be adding it to creditors. Adding it to creditors as unrecorded provisions or unrecorded purchases. So this comes to 13660. 13660. If anyone has any questions, please let me know. Then we have interest on capital at 5%. So this becomes an expense to the business and an income to the partners. So two, interest on capital. Rajesh, Rajesh and Mahesh. Mahesh. So that becomes 5% they've said. So 5% of 70,000 is 3,500 and 5% of 6,000 is 3,000. So this is an expense to the firm or to the business and an income to the partner. So I will show it as by interest on capital. 3, 5 and 3. Okay, now somebody may say if we are showing current account, why is interest on capital coming here? Because it is a payment that is being made, which is being adjusted here in the current account. Okay, because capitals remain fixed. Because it's interest on capital, it need not be added to capital itself. It is adjusted here. All the payments, all the withdrawals by the partners are adjusted in this account. If there was no current account, it would have the capitals would have been this would have been partners capital account. We would have had the capitals here. Next one, Mahesh and Rajesh are entitled to salary of rupees 5,000 each. So again, to salary to partners. Salary to partners. 5,000 each. So each one gets 5,000. Same way we have to add this here. By salary to partner. 5,000 and 5,000. Then we have provisions worth rupees 3,000 were taken by Mahesh for personal use but were not recorded. So what has he done? Like goods withdrawn by proprietor. Or if you remember in the initial problems, accommodation that was used by the proprietor, meals that were used here, he's taking goods. Okay. Normally, we would show this as maybe minus from purchases or goods withdrawn by proprietor. Okay, by provisions withdrawn by the partner, or sorry, not proprietor here but a partner. So by provisions withdrawn by Mahesh, which is 3,000. And similarly we have here drawings. So besides these drawings of Mahesh 8,000, we also have additional drawings. You can say two provisions. Did I say? Yeah, by two provisions. Two provisions withdrawn. And only in Mahesh's column, we will have an amount of 3,000. If you see, we have shown the debit effect and the credit effect. This is the credit effect this side. Here we have shown the credit effect and this is the debit effect. Okay. Like I said, every adjustment has to have two effects. One is the debit effect and one is the credit effect. Okay. Now we need to close. We need to close. Uh, the total this side is 126, 140, 126, 140. To net profit carry down. That comes to the net profit is 25,540. Okay. Now bring down this net profit in the appropriation account by net. Can you put it in the which account? Can we put it in the no? Why we keep the profit and loss? Why we have the profit and loss appropriation account is to make all these allotments to the partners. Okay. For example, if you remember under the old format, when you solve problems for the company form of organization or the new format, any payments of dividends, okay, any payments of dividends always come in the profit and loss appropriation account because what they do is from the net profit, these payments are made. Even if you remember in banking, in the last part, okay, in the last part where you make provision for dividend, okay, that is like a profit and loss appropriation account from the profits. So these are specifically all what is shown in the profit and loss account are specifically business expenses. These are also business expenses, but these are a separate category where they are treated as payments made to partners. So you have to do the profit and loss appropriation account. Its profit and loss appropriation account is always treated as an extension of the profit and loss account. Nevin, is that clear? Okay. So we have the net profit brought down, which is 25,540. 25,540. So this comes to 25,540. Okay. Now, if you see here, the 25,540 minus this, all this from the profit that we have, we minus the payments that have been made to the partners, and that comes to 16,500, which will be the balancing figure here is 9040. Now, if you see here, they have not given us any ratio. They have not told us how to share the profits between the partners. That does not mean we are not going to share. If no ratio is mentioned, it is understood that it has to be shared equally. Okay, it is understood that it has to be shared equally. So the net profits have to be shared equally, even if nothing is mentioned. So to net profit, we have Rajesh and Mahesh. So 9040 divided equally will be give you 4520. 4520. 4520. That comes to 9040. So this is also the net profit that they are earning. So bring down the net profit here by net profit 4520. 4520. Okay. And that will give you your new balance carried down, the new current account balances after making all these adjustments. So here we have a total of 7,000, 8,000, 13,020, 13,020 to balance carried down. To balance carried down. We will have it as minus 4,500. We get 8520, and here there is 8,000, 12,720, 12,720 minus 11,000 becomes 1,720. Okay, now one thing I forgot to mention in the last problems, when it comes to current accounts, sometimes one partner may even have a balance carried down this side. What does that mean is, that means their debits are more than the credits. They've withdrawn more from the business than they've actually earned. Okay, now if you have a balance this side, say for example, Mahesh had a balancing figure this way, that means his debits were more than the credits. That time it will be shown on the asset side. Here you will show it as Mahesh's current account. Okay, right now where we are showing the current accounts here, because both have credit balances. Both are credit balances. How I know this is credit, even though it's on the debit side, when I bring down the balances, it will be by balance brought down. That's what we look at. So both are credit balances. But say suppose one had a debit balance. This was heavier than this. Right now, why it's a credit balance? Because what they've earned is more than what they have withdrawn from the business. Okay, but sometimes they can withdraw more than they earn. So that time one will have a debit balance, show it on the asset side as Mahesh's current account or whoever's current account. So we have the current accounts here. Current account, Rajesh and Mahesh. So Rajesh's current account, he had started with a debit balance, but it has become a credit balance. Rajesh had actually started, that means in the previous year he had withdrawn more than he had actually earned. So it started with a debit balance which has turned into a credit balance 8520. Credit balance, that means he has more in his account. It's a positive balance. And the second one is 1720. This guy had started with a credit balance of 200, it has increased to 1720. Okay, and then the balance sheet total is, the balance sheet total is 165,900. 165,900.